Welcome to my channel. I'm the cover call guy. My goal is to create $120,000 per year in passive income using only cover call ETFs. I currently yield about $7,000 a year and about $6,000 a month. Legal disclaimer before we start this amazing video. This content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions on my own and may be incorrect. Trading and investing involve risk, including loss of principal. Please, always do your own research and consult a licensed professional before making any financial decisions. I'm just some random idiot you found online, and I could be completely wrong. Now, with that out the way, let's start on today's video. It's going to be about expense ratios. I'm going to be using Devil as an example. So let's get started on the structural analysis of expense ratio, yield mechanics, and operational alpha as using Devil as an example. All right, what is an expense ratio? I talk a lot about it in my videos and replying to comments, right? It is the operational rent, right? You're paying rent. You're paying a salary for these uh, uh, active managers, basically to help operate the fund. You're paying them. They need money. They need to get paid to work. An expense ratio is the annual fee paid to the fund company to cover operational costs. It is deducted automatically from assets. You won't see it. You won't really feel it for the most part. What is a 12B-1 fee? Named after a SEC rule, this is a marketing and distribution fee. It is money taken from your investment to pay brokers and financial advisors for selling the fund to you. Good thing, Divo does not charge anything. It charges 0% for that fee. What makes up an expense ratio? Typically, these three standard components. One is the management fee, right? It's a salary for the portfolio managers, stock pickers, and traders. You pay the admin costs, right? Legal, custodial, and audit fees. And then the marketing commissions, right? 12B-1. And often it's a 0.25 to 1% additional tack on, typically seen in mutual funds. But we won't see it here in Divo. The silent daily deduction. The fee isn't a monthly bill. It is a microscopic daily reduction in the share price. We're going to run the math using Devil's real-time data. As of this video, the NAV is $45.68. The expense ratio is 0.560 in decimal, which is 0.0056. The daily cost per share, right? So we're going to use $45.68 as of today, the video being made. That's the share price. Multiply by 0.0056 divided by 365 days equals about 0.0007 per share a day. Now, if we own 1,000 shares at approximately $45,680 total investment value, you pay about 70 cents per day for owning 1,000 shares. It is invisible to you as the NAV would simply reflect $45.67 instead of $45.68. That's why you don't see it. And that is why I always talk about NAV erosion, right? And with these high fees, with all these shares, every time it pays you out on a daily, your regular payout, your distribution, right? If it's taken away from the NAV, it will take that down. And on top of that, you're paying the expense ratio on how many shares you own. So take that down even further. So that is why I always say go for the lower expense ratio, right? Because it matters if the fund is not performing. A detailed breakdown of Divil's 0.56 expense ratio. The management fee takes about 0.55, basically the whole thing. It is paid to amplify investment and capital wealth planning. I believe CWP, they are a options specialist, so they handle the options strategy. This funds the salary of the team analyzing 25 stocks and manually trading options. And then the 0.01 is the acquired fund fees, costs associated with ETFs/funds that Devil might hold temporarily, like money market funds for cash collateral. And then 0% goes to the marketing, so that's good, right? They don't care about it. That saves you money. Gross versus net, the fee waiver story. Early Devil, when I think inception was 2018, gross was 0.96, net was 0.49. When the fund was small, fixed costs such as audit and legal took a huge chunk of assets. To stay competitive, the manager signed a contractual waiver agreeing to pay the 0.45% difference out of their own profit. The current dividend is about gross and net is about 0.56. Now at 5.4 billion in assets, these fixed costs are spread over a massive base. Good thing for us, right? And they went from 2018 to 2025 up almost 6 billion in assets. I mean, they are performing very well. People love it. People want to continue buying and owning it. The gross fee naturally fell because obviously the went up. The fee is no longer needed, and the fund is self-sustaining at this efficient rate. The key takeaway: growth in assets under management directly benefit investors by stabilizing the fee without subsidies. Good thing for us. Thumbs up. Triple thumbs up. Justifying the drag, right? So of course, like I always say, you guys always have to justify the expense ratio because it is a drag, right? It is taking away your it's eating away at your NAV, it's eating away at your gains, your total return, right? On a $100,000 investment, Divo costs $560 a year versus a typical passive fund that costs just about $60 a year. To justify this $500 premium, Divo must deliver specific active alpha. And there's two that I'm going to mention. The downside alpha, which is in 2022, when during the bear market, the S&P 500 fell almost 20%, while Divo fell only 1.5%. Saving 16% of your capital is worth far more than the 0.56 fee. Tax alpha. Divo generates return of capital, ROC. If you save 15 to 30% in taxes on your distribution via tax deferral, you have effectively recouped the entire expense ratio. So that's very worth it. The fee basically buys risk management and tax strategy. Service a cheap index fund cannot provide. So you're paying for how well their active management is, applying their strategy to make you money, right? To justify what the 0.56 fee is that you're paying them. All right, the cost of strategy. I use QQQI as an example. I could have picked any, but I just picked something, another great cover call ETF, I believe, right? I wanted to do Divo versus another great cover call ETF that I believe in. So Divo's expense ratio is 0.56 versus QQQI expense ratio at 0.68. While both are active income funds, the 0.12% gap compounds over time, right? We want to be holding these for 30, 40, 50, 60, 70, 80, 90, 110, 120, 150 years, right? Assuming a hypothetical $10,000 investment growing at the same 8% gross rate, we see here that in 10 years, Divo is worth 20,000. All right, QQQ is worth 20,000. The cost of higher fee is a $230 difference. After 20 years, the cost of higher fee is about almost 1,000, right? QQQI is a newer fund, inception of January 2024, focused on Nasdaq 100 volatility. Its higher fee reflects the higher complexity volatility of the Nasdaq 100 versus Divo's S&P 500 focus. Investors pay more for access to that specific volatile asset class. And both great funds. Divo is not a classic cover call ETF. I need to put that out there. It is more of a traditional ETF with a cover call spin to it to generate more income. Impacts on payouts, right? NAV versus yield. We got to understand the NAV. The expense ratio reduces share price with NAV daily. It does not come out of the dividend check. You will not see it. The yield, because the NAV is lower, the percentage yield might theoretically look higher if the cash payout remains fixed. Common misconception. The fund yielded 5%, but the expense ratio is 0.56, so I only got 4.44%. False. Yields are reported net of expensive. If Divo reports 4.86%, you received 4.86%. Okay, let's not get that mixed up. Right, so if you see the yield reported net of expensive, which basically just means that the the value that remains after all expenses have been deducted from total, right? It represents the final bottom line figure showing the actual profits or remaining amount after all costs, such as operational costs, taxes, and other liabilities have been accounted for. The active premium, why pay more, right? So we use a passive like SCHD with 0.06%. The cost driver is a computer code. They literally pick all their stocks using a algorithm, through a computer code, right? Replicates an index, no decisions, no research, no um, options. I think they literally have like a team of 3 people. I legit think they have a team of 3 people. I can't even find any information on that. It's like 3 people, and then one decides and be like, all right, it's good enough, and click, boom, that's it. That's why it's 0.06%. You're not paying for like an actual team, such as the active ETF like Divo. It has a 0.56% because the cost driver is human capital. CWP team analyzes 25 stocks daily, executes manual option trades, and manages tech slots, right? The 0.56 spread is the salary for the active managers. Right, the cost of goods sold framework. Think of the expense ratio as the cost of manufacturing a specific financial product. Operational alpha. Basically, this is just an example, right? Activity funded by fee, physical execution. Devil example, buying Microsoft directly, whereas passive is just buying a synthetic note. JEPI, tactical trading, right? Trimming McDonald to buy HD, Home Depot. And then passive is holding losers until index rebalance. Volatility management, writing calls on only one stock. Blindly writing calls on 100% of the portfolio. Tax efficiency as a fee offset, the net cost equation. If an active fund creates tax saving greater than its fee, the real cost is negative. And I use Divo as an example here. At the expense ratio, right? You're paying the 0.56 fee. The tax savings rock plus 0.12%. Net value, you gained 0.64%, right? Devil's edge is that because the 0.56 fee funds the active, sorry, because the 0.56 fee funds the active management required to generate return on capital, investors in high tax bracket effectively make back the fee in tax deferred savings compared to a cheaper fund generating ordinary income like JEPI. Conclusion: is the price worth the value? My verdict: the expense ratio is not just a cost, it is a purchase, right? In Devil's case, you are purchasing a structural advantages, physical ownership, tactical flexibility, tax efficiency that passive funds cannot offer. While 8.56% creates dragon returns, historic the historical ability to outperform peers by more than 200 basis points, right, net of fees, validate the expenditures. Ugh. You get what I mean. I personally believe Devil is a top 3 ETF, if not top 1 income ETF. Again, it's not a traditional cover call. I'm not gonna call it a cover call ETF. Even though it does get labeled as one, it is a traditional ETF with a cover call spin to it. That's why it gets put into the cover call, community and talks. But I think, not financial advice, I think it's a top 3 income ETF. Yes, it has just about a 5% yield because it's not a real cover call ETF that can have that high expense, high yield, right? It holds aristocrats, right? So stocks that's been paying for decades. So these stocks don't pay a lot, right? You're getting paid most of the income is from the dividends, and then to juice up an extra 1 or half a percent or 1%, they use cover call ETFs. So great ETF in general. Let me know if you think it's worth it. Subscribe, comment, like. And this video was requested by Lala Gardina. Gardina? I don't know. 6,500. Appreciate the comments. I was gonna make an expense ratio video already, but then you commented that you wanted Devo, so I just typed a few things, edited a few slides, and just used Devo as an example. Thanks for leaving that comment. So this video is for you and anybody that's wondering about expense ratios. Thanks for watching. Stay tuned. Catch you guys on the next.